Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then if you have any questions, you can ask our speaker after his presentation or during his presentation. I have great pleasure of welcoming Professor Stephen Penman. Stephen Penman is one of the top accounting thought leaders in the world. He is a professor of accounting at Columbia University, where he is also co-director of the Center for Excellence in Accounting and Security Analysis and the director of the Master Program in Accounting and Fundamental Analysis. Professor Stevens received a first class honor degree in commerce from the University of Queensland, Australia, and M.B.A. and Ph.D. degrees from the University of Chicago. His research deals with the valuations of equity and the role of accounting information in security analysis, and number of his papers deal with accounting policy issues. He has published widely in top-ranking journals in accounting and finance. Penman was awarded the Notable Contribution to Accounting Literature Award by the American Accounting Association and the American Institute of Certified Public Accountants, and was awarded the American Accounting Associations and Deloitte Touche Wildman Medal for his book Financial Statement Analysis and Security Valuation. He was awarded the Institute for Quantitative Investment Research Prize in the UK. He received an honor doctorate for the Stockholm School of Economics and was elected to the Financial Economists Round Table. Stephen Penman is a founding editor of the Review of Accounting Studies and served as managing editor. In 2019, Penman was elected to the Accounting Hall of Fame. In 2020, he was elected to the Australia Accounting Hall of Fame. Now we will start our seminar with Professor Stephen Penman.
Thank you very much, Mohammed, for that kind introduction. And thank you for inviting me to this forum. And let me congratulate you on organizing this forum. I guess it's one benefit of the pandemic that we've actually been able to communicate more worldwide with these seminars rather than just having our local seminars at our university. And we hope this will continue. The title of the paper is on the screen for you. It's a long title. We haven't quite worked out how to reduce it as yet. But the point that says that income statement mismatching is said to be loose information. The idea of the paper is to show that, indicate that actually the mismatching does convey some information. It's almost also been said that this mismatching has increased over time, and that has reduced the informatives of earnings over time. And that is a claim that we challenge in this paper. My co-author, who is in the audience here today, is Hangil Oh, who is at the Korea Advanced Institute of Science and Technology in Seoul, KAIST. Now, in terms of the rules here, we're going to have a Q&A at the end. I'll leave 10 minutes or so for that. If you have during the seminar a question or a clarifying question, please raise your hand on the Zoom thing here, okay? And I will try to recognize you. If the questions get too much, they're going to cut it too much into my time, I may have to leave you until the end of the seminar. Okay. So with that, let's go. So as I said in my introduction there, the existing research has claimed that the information of earnings has declined over time. This is usually by regressions which look at R-squared, the ability of earnings to explain stock returns. in the standard capital markets research mode. I've just indicated a few of the papers on the screen there. Backing up that is a claim that this is due to increasing mismatching of expenses to revenues. One of the traditional classic accounting notions is that we recognize revenues according to revenue recognition principles, and then we subtract expenses that are incurred to generate those revenues. And that gives a measure of value added, if I may use that term. That is output value versus input value. Now it may be that information of earnings has declined over time. We're not addressing that question, but we are challenging the notion here that this is due to increased mismatching. The mismatching, it is said, is due to actually more fair value accounting in corporate reporting, where in fact, of course, it's just change in assets values rather than a matching of revenues to expenses. But secondly, it's the increasing expensing of investments in the income statement rather than booking them to the balance sheet. These are so-called intangible assets. We are dealing with a second notion here. We're not dealing with the fair value accounting issue. We're dealing with the second issue. Okay. The idea here, of course, is there's a long number of papers which make this claim. I've only indicated a few here. The idea is that, look, if in fact if you really want to think about investment and return on investment, you've got to put the investment on the balance sheet. And so the return on the investments come through the income statement. And when you match the return on the investment to the investment, you get a rate of return on investment. And that's a clear separation of investments from the flows of investment, or in traditional terms, a clear separation of stocks from flows. When in fact you now start expensing the investments to the income statements, you're mixing up stocks with flows. You're putting the investments in the numerator and corrupting the earnings that come from investments. And of course, you're leaving out, you're reducing the denominator in the book rate of return. That is the investments on the balance sheet. And the claim is that this has led to, because intangible investments, the type that are expensed in the income statement, are increasing over time relative to tangible assets, this has led to a decline of the informers of accounting. The associated policy direction from these papers is that, hey, listen, accountants are messing up by actually doing this. They should put these investments on the balance sheet. So that's the background, and it's the background that we want to. There are certain ideas behind this. These claims that first we want to challenge, but also we want to challenge the notion empirically. And the first part of my presentation is going to be challenging this second notion here, the second point here, in terms of and to indicate that there may be a rational reason for expensing these investments to the income statement. But that'll be followed up by, in the latter part of the presentation, of the empirical investigation, which to support our contentions. Please note that behind this all is accounting policy issue. I'm an accounting academic. I like to do work on accounting, and like to do work on accounting which has policy implications. What is good accounting and what is bad accounting? That is the focus of our center at Columbia, for example. It's a focus of our accounting design project seminars, which are very similar, worldwide seminars similar to this. And so behind this is an underlying issue of how do you account for intangible investments? And we're going to address that. The expense investments, so you're familiar with them. The marquee one, of course, is R&D. R&D, research and development. I should say under US GAAP, we expense all expenditures on research and investment, though I recognize under IAS 38 that only the research part is expensed. Though I am told that in Europe and elsewhere, actually most of R&D is expensed. There's not a big separation between research and development, so I'm told. Advertising, brand building, promotion, to build brand assets. These are expensed. Investments in human capital. Most software, many software investments are expensed until you get to technical feasibility. And then there's all those expenditures in customer loyalty programs, developing supply chains, developing distribution systems. These are all require considerable expenditures, and particularly in the modern corporation. And so it's deemed that that actually there's a big increase in these expenditures versus intangible assets, increasingly over time. So more and more we're seeing investments expense to the income statement. In this global economy, developing those the supply chains, those distribution systems to get your goods into Walmart or to Amazon or wherever. This is very expensive, but it all gets expensed to the income statement. So that the claim is by not putting these assets on the balance sheet, we're actually reducing the information content of earnings. And the solution, of course, is to capitalize investments. One of the big academic champions of this is Baruch Lev, my former colleague at Berkeley and now down the road at NYU, who advocates listen, you accountants, you've got to get these investments on the balance sheet. So this paper, what does this paper do? Well, here's a summary of the results. There's actually two aspects of the paper. One is the substantive aspect, which we're going to spend time on. Now there is a methodological aspect. Where a paper actually develops a regression specification to deal with the issue. I'm not going to spend time on that in this presentation, dealing more with the substantive issues. But if you get hold of the paper, I think you might find something by actually going through how we develop a regression specification that actually identifies information in the financial statements and the pricing of that information. So on the substantive issues, here are the results. Mismatching conveys information. And what it does is convey information about risk. It does so by distinguishing investments with particularly high risk, which are expense, from those that are booked to the balance sheet. And so, for example, if we have inventory, which it's likely that we can sell tomorrow, we put it on the balance sheet. If we have plant, fixed assets, which produce a known product, which we can sell tomorrow, we put it on the balance sheet. But if we're doing R&D into a product, well, we don't know what the product is yet, let alone whether we're going to be able to sell it tomorrow or in the future. There's a high degree of uncertainty. And the accountant says, no, I can't put that on the balance sheet. Okay. And so the differentiation is on the degree of what in finance we call risk, but what accountants would call uncertainty. And actually, this mismatching actually conveys that information. Interesting, and maybe it seems like a incorrect statement. Mismatching actually preserves matching. And we're going to show how that happens. And then the third thing is that now when this is recognized, that the expense of investment has not reduced the informative earnings over time, even though there has been a very large increase in the investments in these expensed investments, these mismatching investments, which we document that increased expenditure on these investments versus tangible assets in the paper. So they're the three results, takeaways that we want you to take from the paper. And now it's up to me now to sort of explain how we come to this a priori, if you wish, and then how we actually validate or provide the supporting evidence empirically. So the operating, it's a matter of accounting, okay? It's a matter of accounting principle. I spent a lot of time, a lot of my work in recent years has been dealing with accounting under uncertainty. And I've come to the conclusion that much of our accounting is driven by how we handle uncertainty. We're going to look at expense matching to revenues here, but in the background, of course, is the revenue recognition principle, the realization principle, which is really just a matter of reacting to uncertainty. We do not recognize revenues until uncertainty has largely been resolved. That is clear there in IFRS 15. Both contracts have got to be completed and receipt of cash has to be, quote, highly certain, okay? Before that, we don't recognize the revenues. That's not the issue here. The second aspect of that is, in terms of recognizing expenses and recognizing investment, under what's referred to as conservative accounting, we do not recognize investments on the balance sheet if the payoffs to the investment are particularly uncertain. Now, many of you in the audience are accountants. If any of you have objection to actually, this is the way accounting works, please let me know immediately that there's something I'm missing out of here. When I learned accounting as a student, I was told, no, you recognize revenue because of the realization principle, the revenue recognition principle, and then you match expenses. And that gives you value added. I've come to realize I was taught incorrectly that we don't do that. We do a heck of a lot of mismatching. We don't mismatch because we expense these investments and create mismatching. But the rationale here is we do it because actually the payoffs are uncertainty. It's a reaction of the accounting to uncertainty in terms of driving both the revenue recognition principle, but also the matching of expenses to recognition. And now, just for the authoritative support, I've given references here. In the IASB's conceptual framework, they defined an asset as something to produce future benefit, but when it comes to recognition, it says, if there's significant uncertainty about the outcomes, you cannot recognize the asset. And we say that in FASB statement 2, where actually the FASB says we don't recognize R&D because of the uncertainty of future benefits. In IAS 38, where we distinguish between research and development, the criterion is, again, the probability of future economic benefits. You get to a certain stage, the development stage, then there's a revision of the probability whether there be certain, will there be future benefits. Until that point, you've got to expense. Even in IAS 16, on property, plant, and equipment requires the benefits to be probable for it to be booked. And IAS, actually, that says IAS 37 there. That should be, that's 17. That should be IAS 37. Okay, IAS 37. My apologies there. Introduce uncertainty, recognizing assets and liabilities. So actually, it's this is not just observation what we do in practice. This is actually backed up by actually formal regulatory standards and prescriptions. Okay, so just to give you get a little more introduction here. Suppose that I'm a startup. I do R&D into drugs, okay? And I'm looking for a cure for pancreatic cancer. And the probability that I'm going to have success is only 5%. The complementary probability is that if I book it to the balance sheet, that there'll be a 95% probability there'll be impairment in the future. An expected impairment is an expected mismatching. So I'm going to expect a mismatch in the future. So rationally, I should say, look, if I'm going to mismatch in the future, maybe I should, under these conditions, I should mismatch now. Rather than booking to the balance sheet and pretending that an asset exists which serves as collateral like property, plant and equipment and inventory. There's a very different degree of uncertainty between these two types of assets. This is just an illustration of an uncertain situation. Now, we get to a situation where, well, I don't know what the threshold would be, but there's a 95% of payoff here. We're past phase 3 trials. We've got the doctors begging for it, the drug. Then you'd say, look, there's been quite a revision in the uncertainty. Maybe then I can book it. And I guess that is the rationale under IAS 38 when development is actually capitalized rather than expensed. And actually, this is, by the way, this is largely what we're talking about here is what the academics call unconditional conservatism. There's also, of course, the notion of conditional conservatism. When you get information that actually, in fact, you've booked an asset to the balance sheet, and there's indications that actually earnings are going to be impaired in the future because there's going to be loss. The carrying value is actually greater than the expected value from the payoffs, then we impair it. I always see a conditional conservatism is just another application of the basic principle of dealing with uncertainty. Oh, I made a mistake. Or ex post, I have to revise my unconditional conservatism because I have new information that says now I have to write it down. So that's the thinking behind the accounting, I believe, supported by those authoritative statements from ISB and the FASB that I've referred to. Now you say, well, okay, is this just the accountants screwing around? Okay, they're conservative accountants. Okay, they want to be conservative. They're worried about lawsuits. They just want to be conservative, and their behavioral reaction is damaging to our reporting. Well, the answer is no. I refer you to a paper by myself and Chao Jung Chung at Berkeley, where we actually deal with conservative accounting for investments and also the revenue recognition principles. And in a theoretical analysis, as a matter of theory, we connected this accounting to the discount rate in a general no arbitrage asset pricing model. Okay, starting with a general model where the risk is in the covariance term with the so-called kernel. We tie this accounting to that and show how that actually, in theory, it forms about priced risk. And where we're taking, of course, no arbitrage asset pricing as the modeling of priced risk. Okay, so now there's a complementary feature here, which is to be recognized in terms of, now remember this description here, these, it's a cacophony of voices saying, you accountants, look, you can't put investments in the income statement, you've got to put them on the balance sheet, okay, and really show your assets. But there's a complementary feature here that if an asset is booked to the balance sheet, it then must be amortized against revenue in the income statement. That is, you book R&D to the balance sheet, you've got to actually, or brand building or whatever, you've got to develop an ex-ante amortization schedule, which to run against earnings. Now, of course, we understand that mismatching gives you a problem in the income statement, but poor amortization also creates mismatching. And so there's a tension here, okay? Yes, you can put it to the balance sheet, but if the associated mismatching, associated amortizations introduce mismatching error, you're going to be destroying the information in your income statement. In other words, this is a put it perhaps more bluntly, the requirement that assets, intangible assets with high uncertainty be booked to the income statement and to the balance sheet says that, look, there's only a balance sheet. But no accounting, we understand, under the double entry system says there's also an income statement. And what you do under the balance sheet, under double entry, has effect on the income statement. So you cannot establish accounting for the balance sheet without the consideration of the effect on the income statement. And that effect can create mismatching, which destroys information. Now, of course, expensing immediately R&D and all these other intangible assets immediately creates mismatching. But it doesn't necessarily follow that putting it on the balance sheet actually resolves the issue of mismatching. It can, in fact, create mismatching. We have an idea of matching when we say, look, here is revenue from goods sold. Here now is the cost of the inventory, which actually was delivered to create that revenue. Take the revenue minus the cost of goods sold, gives you the gross profit. And we can see that it's actually reasonable matching. The revenue is matched to the cost of the goods to deliver the revenues. Subject, of course, to absorption costing and other aspects, LIFO versus FIFO, and other aspects of inventory, the inventory accounting. We typically say, listen, we'll put property, plant, and equipment on the balance sheet and then amortize it, because evidence suggests that we can actually do that, particularly on a pooled asset basis, without introducing too much mismatching error. We don't observe big gains and losses on disposals, which are correction for bad amortization, bad depreciation. We typically don't observe those. Of course, there are exceptions. And of course, that remains an issue. We'll probably point out what's the best depreciation schedule. Okay. But when it comes to these high uncertainty assets, we have to ask, can we do it? So again, we're back to this R&D with the drug. There's no product as yet. There may not be a product. There's no customer. There's no revenue. And the projected revenue is very much in doubt. Look at the balance sheet. What is the amortization schedule? Well, it's very much a guess, isn't it? It's very much a guess. We don't know whether there's going to be any revenue, let alone the periodic revenues against which we do the matching. And so establishing that amortization schedule is either, and actually it's possible here that we're going to introduce considerable error if we start to do this into the income statement. So the point behind this is I'm sort of wandering intentionally. I'm wandering off to accounting policy here too, because that's my bug. That's what I really think is our core mission, to think about what's good accounting. So I'm wandering off into these issues as background to this paper. There is not just a balance sheet. There's an income statement, and actually, in many cases, we see the income statement as being primary. Okay. And to preserve the information in the income statement is very important. If I get fuzzy earnings, I'm all over the shop. So the remedy may be, if you're going to have mismatching, You can't get the amortization schedule. You're going to introduce big mismatching through an amortization schedule. Why does just not upfront mismatch it and don't introduce the subsequent mismatching? If that's reported appropriately, and unfortunately it's not reported very well under current accounting, it avoids the mismatch, but also conveys information. If in fact this investment is investment which is much more risky than that that's booked on the balance sheet, you're conveying, hey, you're making investments here, but actually the outcome to the investments is highly uncertain. Maybe you want to think of high risk. It's high risk. And actually that Penman and Jung paper in the JE actually models that and says, yes, in fact, it does indicate risk in the discount rate. Okay. So you're conveying information here up front. Now, as I said, accounting, as we do it, we're not very clear about this. R&D tends to get a separate line. Advertising doesn't usually get a separate line in the US, but the US income statement is a disgrace. There's only 5 or 6, 7 line items, okay? If you go to the footnotes, you'll find that actually you can find the advertising and promotion separated out. But in SG&A, and there's considerable work done on this in SG&A, selling general administrative expenses, a lot of these investments in human capital, developing those supply chains, customer loyalty programs, distribution systems, they're all buried in SG&A with very limited disclosure under current requirements as to that SG&A. If anything that would follow from this discussion would be, hey, listen, give us more detail on SG&A. It covers a multitude of sins, and we need more detail on that. Okay, so that's a perspective here. So here, I think now I'm repeating myself here. Recognizing intangible assets on the balance sheet is seen as a matter of getting a better balance sheet, and that's very necessary, they say, to solve the problem. You accountant, you give me a lousy balance sheet. Some assets are not on the balance sheet. We get very disturbed when there are liabilities not on the balance sheet, with special investment vehicles and other structured off balance sheet liabilities. Okay, and so it follows up. Well, you have to have the assets on the balance sheet too, but under double entry, there's also an income statement. And you've got to look at the consequences of the income statements. Those of you who work in valuations understand that typically you work with balance sheets and income statements. The residual income model actually is a model with balance sheets and income statements working together. And that's how you get to valuation. The idea that you might get a better balance sheet, but then destroy the income statement, then actually you can run this through in a residual income model. That's going to really give you very fuzzy, very difficult valuations. So that's sort of the commentary here. I'll take the opportunity to just refer you to 2 other papers, which are policy papers. This is the first paper was with Richard Barker at Oxford University in the UK. And the second one was with him and Andrew Leonard, who was just finished at the Financial Reporting Council, and Alan Shearer, who used to be the head of research at the ISB and is now sort of the chief technical guru at Deloitte in London. What these papers do, or the Barker and Penman paper, says, look, how we think about capitalization. And this is what they offer. Under uncertainty, because of this balance sheet and income statement trade-off, under uncertainty, book an asset to the balance sheet if an evidence-based amortization scheme can be established with minimal mismatching error ex post. I anticipate ex post there'll be minimum mismatching error. Okay. That is, you recognize on the balance sheet with the idea of preserving the income statement. So if in fact you make an investment in inventory, put on the balance sheet, because the way it's going to work, that's going to give you good mismatching when you recognize the revenue. Property, plant, and equipment, well, there are some problems with depreciation, okay? Problems with depreciation, but typically, I said, the gains and losses on disposal, which are correction to depreciation, not large. Put it on there because you're going to establish evidence-based. History has shown that, at least on a pooled asset basis, this actually gives you a reasonable matching, okay? Here's your revenue minus the loss of the cost of the amount of investment in the plant, which was made to actually develop this depreciation. Now I know with property plant there are problems, and some people want to add back depreciation, EBITDA, and add back depreciation and amortization because I think that these numbers are bad numbers. There are certainly accounting issues in this, but that's very different from my R&D example here, where you just have to throw up your hands on establishing an amortization schedule. So that is offered in these papers. This is rather a digression from this paper, but this is my bug about looking at accounting policy. Here's you just don't put all intangible assets on the balance sheet. You put some tangible assets when you get to a degree of uncertainty or a degree of certainty, if you wish, whereby you're not going to actually significantly introduce information destroying mismatching in the income statement. Of course, both the IASB and the FASB are very much looking at intangible assets counting, and of course amortization. They're looking at goodwill and whether goodwill should be amortized. So these issues come into those discussions. We used to have amortization of goodwill before FASB 142 and whatever the IFRS equivalent was. But people, of course, it was just arbitrary. Analysts just routinely added back. A guess of a 40-year life and amortize. They just routinely. This is rubbish. This is rubbish amortization. We'll add it back. And that I think was part of the motivation for 142. Now, goodwill, of course, is an asset which potentially is an indefinite lived asset, which indefinite lived assets which may in fact not lose value, which of course is the other justification for actually subjecting it to impairment rather than to amortization. But I think under accounting, if a firm makes a bad acquisition, very quickly that gets impaired, and you get the mismatching. Okay, so this would be the point. This would be the point. If you have any questions or any discussion here about the setup here, it'd be a good time to raise your hand. Because as you can see, there are policy issues behind this. You know, the amortization in the literature, Baruch Lev and Shiva Stava papers, they insist that Lev and Sujanis, they insist that you can actually infer an amortization schedule from R&D by just looking at the data. Look at firms. Look at the payoffs and look at what the average amortization schedules would be within firms in the same industry, for example. That may be quite helpful for an analyst who wants to get a rough guess, but it's not has no real significance in my mind for accounting, because accounting we want to understand. Hey, we want to differentiate firms, okay? R&D is very firm specific. Not many firms are working on the same R&D. It's very firm specific, and we want to distinguish the value in that R&D. Taking an average for an industry and applying it to every firm, of course, doesn't add any information. Okay, it doesn't differentiate. And secondly, when they get from the data, they actually establish these empirically in indices. What were these amortization rates? And it's also done with advertising and so on. They don't, of course, they only have firms which the R&D is successful. And most R&D, I'm not sure what the expenses percentage is. I shouldn't say most, but a significant amount of R&D is unsuccessful. They're not in the data. And of course, the amortization rates for an industry or a firm, you apply them, well, then actually, they're not specific to that firm, so you're going to have impairments. And in that the empirical estimation of these amortization rates doesn't pick up impairments. The case where firms actually had to write down, would have to write down the R&D if in fact they employed these industry-wide amortization rates. So that attempt to deal with the amortization question, I think, by reference to empirical numbers for industries, I don't think quite works for the point of view of establishing an amortization schedule. Okay, so that's sort of the setup here. Okay, for the paper. The paper is with this thinking. The paper is largely an empirical paper. And so what I'm going to do for the rest of the time here is to look at the empirical analysis in the paper. But I do hope you sort of understand where we are coming from in this paper and the thinking behind it. If I can be so blunt, I think there's a naivete in terms of the idea that you should book intangible assets to the balance sheet. And I hope we've actually demonstrate that naivete. Okay, and of course, it largely is around the idea that they're both income statements and balance sheets that have to be convey information together. So here are the empirical questions for the empirical analysis. Are mismatched expense investments priced at a risk discount relative to assets booked at the balance sheet? Now, the theory paper says, yes, they should be. Okay. Our intuition would say, look, if there's more uncertainty about the payoffs, then that should bear a risk discount as long as that is priced risk. Okay. A price risk, of course, means this is actually a firm that's going to be hit when in fact you have a loss to consumption, if you would put it broadly that way, or a downturn in markets. Okay. And which may pay off very well when you have good times, following the logic of consumption-based asset pricing theory. Okay, so do we observe that in data? That's the first thing that we try to draw out here. The second thing are matched. By the way, there are other mismatched expenses in the income statement. Okay, there are impairments. There are recognized gains and losses, which really are fair value aspects. We don't deal with those, okay? Although they do, they are in our empirical work and our regression specification, because we want to control for all the information in the income statement and the balance sheet. We're looking primarily at the mismatching that comes from these expense investments. The second issue is, are matched earnings priced appropriately, given the mismatching? And that flows, of course, from the point of view that if, in fact, you do book these mismatched expense investments to the balance sheet, you're going to create mismatching by actually expensing them immediately. You're preserving the matching that goes onto the income statement. Okay, and that so that comes empirical question: is that preserved? This is sort of the what seems to be a circular statement that mismatching mismatching actually adds to matching, okay? Which is one of the underlying points that I've been making. And so then once you recognize this, once this information is recognized, is there a decline in the informative of earnings over time? Okay. The answer to the first question is going to be yes, as the data says. The answer to the second question is going to be yes, according to our empirical analysis. And thirdly, the answer to the third one is no, okay? Once you recognize this information, there is little evidence that in fact the information content has declined over time. There is a slight exception, which I'll refer to here, okay, when we come to the empirical work. Okay, so let's go to it. The standard metric for this information content is R squared, goodness of fit, the ability of earnings numbers to explain prices, or more particularly, the ability of accounting information to explain returns. That's a standard metric, and it's a metric that we're going to be employing here largely. There's a very well-known paper by Baruch Lev, I think it's way back in 1989, that accounting earnings don't have a lot of information content. The R squareds are low. When you have annual returns on annual earnings or annual earnings changes, okay? I think in his paper back in 1989, it was only 5% R squareds in contemporaneous return earnings regressions. And that has been seen as a failure of accounting to provide information about the updating of prices, which returns, of course, capture. I've come to realize that we should not expect earnings to actually give you very high R squareds in regression. That is, earnings being a complete sufficient statistic for returns in the extreme perfect R squared case. And the reason is simply because the accounting that we talked about. Prices anticipate future earnings. The accountant says, I'm not going to recognize earnings until I get the resolution of uncertainty. So counting principle, by construction, should not explain the speculative prices which are anticipating future earnings. Because the accountant says, I'm not going to speculate. I'm actually going to wait until I get the realization of the revenues. Secondly, of course, I'm going to mismatch because of this expense investment with the justifications that we have gone through. So just to recognize that a low R squared can be an exhibit of good conservative accounting, which actually handles uncertainty. You can go and buy Telsa at 1,100 price earnings ratio on the anticipation it's going to deliver a lot of earnings. But the accountant says, no, I'm not going to actually book those anticipated earnings and add to your balance sheet until you get a customer, until you get the resolution of uncertainty. And that's how it works. The criticism of accounting has been, it's always recognized as value with the delay from prices. Prices recognize value earlier than earnings. Well, under accounting principles, that is how it should be. Because under conservative accounting, we say, look, we don't recognize the earnings until you agree. You can bet, you can speculate, you can gamble on future customers, but we're not going to do that. We're going to wait till we get the customers. Now, of course, we do have a variation on that. I'm talking about standard historical cost accounting, which I'd rather call realization accounting. We do that when we come to fair value accounting. At least in principle, we say, look, I'm going to book the present value of all the future customers and the cash flows I'm going to get from them, I'm going to book them in the balance sheet. That's a very different way to handling risk. And so that, which is actually in my mind, again, I'm wandering a bit here off topic, but that in my mind, that is the critical edge on actually thinking about fair value accounting versus historical accounting. Am I going to recognize the future before I actually get to the future? Again, just to give a flavor and give a background, because I think actually background perspective is so important, even more important than the numbers I'm about to show you. At Columbia, we're very much involved in value investing. We have a strong value investing program, which was established way back by Benjamin Graham and the other fundamentals, Dodd and Murray and so on. Warren Buffett came out of that program. And value investing or fundamental investing really had an origins by a reaction to the accounting, as I read the history. In the 1920s, in the boom times, accountants wrote up the balance sheet to recognize the anticipated future. Much like the advocates in the late 1990s bubble, when people, academics including, say, listen, you've got to get these assets that the market's valuing onto the balance sheet. Well, it turned out, of course, in one day in October of 1929, all these asset values evaporated. Benjamin Graham got hit. John Maynard Keynes got hit tremendously. And both of them became very dedicated fundamental investors. And what they said was, you accountants, do not put water in the balance sheet because water can evaporate. Don't tell me you got value until you get a customer. And that became the advocacy of value investors of good conservative accounting. Keynes, many quotes from Keynes, which actually now advocates this, as well as Graham and the rest of them. And the SEC, of course, was founded on that basic notion of conservative accounting in 1930, in reaction to that crash, the asset, the water in the balance sheet evaporating. Again, I just add this to indicate, the claim, the superficial claim that the accountants are messing up because they're putting this on the balance sheet. It actually has a long history behind it. This conservative accounting, which I would call accounting that don't recognize earnings and add to the balance sheet under the clean surplus relation until you actually get delivery. Okay, so we shouldn't be looking for perfect R-squareds here under these accounting principles. Now it turns out there's a methodological contribution in the paper which I mentioned earlier, which I'm not going to cover. Where again we run the regression. One of the targets is R-squareds. And the decay of R-squareds over time. Okay, but first of all, so you've got to be careful about how you specify these regressions. The Baruch-Lev regression, had returns regressed on changes in earnings. Okay, which is sort of the Ball and Brown metric. Okay, and we understand that it's actually the levels of earnings plus the changes in earnings which are actually important. The Lev regressions in 1989 didn't have a balance sheet. Well, you can't have an income statement without a balance sheet because the two work together. And there are other issues here. And this paper adapts the Penman-Yehuda regression in a paper in 2009, which actually is a regression which actually allows us to draw certain inferences. As I said, I'm not going to go into it. That would be almost a whole seminar on how to specify these information regressions, as we call them, in information content regressions, as we used to call them in our capital markets research. But actually, it incorporates all the information in the financial statements, all the line items in the balance sheet, the income statement, and the cash flow statement, and by implication, all the line items that add up to those bottom line numbers. It actually characterizes the perfect R-squared case. What is the information that gives you a perfect R-squared? And therefore identifies the information that is not being incorporated in accounting in a less than perfect R-squared case. And you guessed it, it's information about future earnings that have not yet been recognized, or growth over current earnings. And certainly Go provides interpretation of any coefficients. And a coefficient on earnings then takes on a very explicit interpretation. If in fact the earnings give you a sufficient statistics for the future, the coefficient has to be 1. If the earnings actually are correlated, it measures such that they give you future earnings growth, the correlation is going to be greater than 1. Okay, and so, for example, if in fact you are expensing investments, you're reducing earnings, you're increasing expected earnings growth, so that coefficient on earnings should be greater than 1 to indicate the multiplier. And so the curve takes it on the multiplier interpretation. We'll see that coming up in the empirical result. Wonderful. John Jiang from Michigan has given me a hand. Let's have the question.
So, Professor, really appreciate your perspective. So what do you think about, the different stakeholders are focused on the valuation? Remember, from Fisher Black and a lot of analysts, when they value firm, they really focus on the flow, like the PE ratio, the discounted cash flow, really about the flow variable. But for a lot of advocate of like Brooke Lab about adding the R&D to the balance sheet, really they are focused on the valuation of the balance sheet.
Yes.
So you emphasize, right, the conflict between these two aspects, right? The people who think about anything to the balance sheet, they ignore the income statement. So how do you kind of comment on why they have this different perspective, right? You mentioned historically, Keynes, right? Graham, they are actually, because they are burned, but at a long time ago, right, in the 1920s, 30s, maybe people really focus on balance sheet, right? Only maybe recent years, they start focusing on income statement, but a lot of commentators haven't catch on. Is that particular the reason for people's different perspectives? Thanks.
Yes, there are a lot of conjectures in your question here, and it could be historically there was more focus on the balance sheet. I think because a lot of original investment was and people will maintain that a lot of the accounting was oriented more to debt holders and the collateral in the balance sheet. Okay, back in the 1920s and earlier, when equity investment became more wide, the emphasis, at least in the US, moved to the income statement. As to your question of why some emphasize the balance sheet and why some income statement, my reaction, and I hate to use this term, it's not accusatory, but it's a naivety. Okay, balance sheets and income statements work together, and you've got to have both of them. Okay, yes, there's value in the balance sheet, and that may give you part of the value. The accountants have done some value in the balance sheet. If they say there's a liability there, you probably better believe it. Okay, the shareholder's got to pay off in the future, but it's not complete. There's also an income statement. The two have to be used together. But it is the case that those who just emphasize the income statement, the PE ratio, without understanding the balance sheet, have a problem. I can give you higher earnings by simply changing my balance sheet. I write down inventory. What's that going to do? Cost of goods sold next period. It's going to give me lower cost of goods sold and higher earnings. But if it's a purely accounting maneuver, it shouldn't affect the price. It'll affect the PE ratio. I got to use them both together. And that's just, I think this is just accounting 101. That's why I call it naivety. This is just how it works. Mm-hmm. And if
so
in fact,
once Doc Skinner mentioned this, very radical idea about decoupling the balance sheet from income statement, saying that maybe forget about a clean surplus accounting, right? People who are practitioners, analysts who want a great income statement, let's focus on income statement. But the people who are focused on balance sheet, let's focus on balance sheet. Forget about, because in reality, it's already a lot of dirty surplus item, right? Bypass the income statement. So maybe that's one way to reconcile these two views. What do you think about that?
Well, I actually don't know the Skinner point that you refer to, but I don't agree with it. Okay. Now remember, it depends. Accounting always depends on to whom you're reporting. Okay. And my context of this paper is I'm reporting to equity investors. Okay. So it's about equity investors and evaluation. Okay. And accounting says for their purposes, I just don't have a balance sheet, I have an income statement. In fact, the whole accounting system, nominally at least, is a system for tracking the shareholders' equity. We do our accounting for earnings, okay, and you can go off and do that. You can do that separate from the balance sheet. But accounting says, no, your final entry in the accounting cycle is you've got to close those earnings to the balance sheet. You've got to add them to the book value of shareholders' equity. And the double entry system then says in the balance sheet equation, which is the product of that, says that book value of equity must equal assets minus liabilities. So you cannot recognize revenue without adding to the accounts receivable or cash. And you can't recognize an expense for pensions and without creating a pension liability. As a shareholder, I'd want that. What is my liability for pensions? It comes from the fact I employed employees to actually generate revenues. So we talk about the properties and the miracle properties of the double entry system. I don't think we quite understand the depths of that statement. I'm very, very impressed by the properties of the double entry system and how informative it can be. And that requires using both of them together. So, having an income statement which doesn't reconcile to a balance sheet, it doesn't reconcile, you're counting earnings to the common shareholders as net income, it doesn't reconcile to my equity you're tracking. It seems to me that's almost absurd. Now, of course, there is other comprehensive income, okay, which you point out is not in the earnings. And the FASB and ISB is moving towards actually including that other comprehensive income in the income statement. Fortunately, as it is, that other comprehensive income is actually mainly unrealized gains and losses, okay? Unrealized gains and losses on securities, currency translations, and so on, which for the purpose of valuation typically mean zero in expectation. Okay, they don't affect my estimate of future earnings. So I very much like the income statement, which actually separates out that income which has a multiplier that tells me something about the future versus that which does not. Okay, and the fact that this other comprehensive income has a it doesn't tell me about the future. It's very good to separate that out. Whether you want that in a separate statement or whether you want an income statement is another question. That's a long answer to your question, John.
One last question. So what do you think about the cash flow statement? It's already out of this double journal entry framework, right? And yes. You commented that because of the presentation of the cash flow statement, that actually caused a lot of misunderstanding. What is the accrual accounting used in academic research? Right, so you actually in the past recommend how to reform the cash flow statement, but the cash flow statement seemed like didn't fit well with the balance sheet and income statement. How can you bring that into the whole framework?
Well, if you go to this paper of this methodological contribution, you'll see how that's handled, okay? You'll see that there's actually a proof there that says that the cash flow has no relevance to the valuation of the equity, okay? And you can see this very clearly in the case of where you have no debt. Free cash flow is always equal to dividends, and under M&M assumptions, dividends don't matter, okay? So cash flow actually under economic theory is irrelevant to equity, and actually in accounting, when you update the shareholders' equity through earnings, cash flow drops out. It's there in the double entry system because it actually is the third aspect of articulating income statements and balance sheets. It's always explained by earnings and the changes in the balance sheet. Okay, so it drops out. Of course, cash flow is important for other purposes because we understand it's not just an issue of value, but it's a question of liquidity and solvency.
Thank you.
Okay, very good. So if you're interested there, and I must say some of the inferences I'm going to make here are going to be based on understanding a bit of this methodology, but I can't go into it. I want to leave you 10 minutes at the end for questions. Here's your data. Usual things start in 1964, goes to 2017. It's all US firms, all US listed firms, except for financials and I think utilities. If firms have some missing data in a year, no income before extraordinary items, and so on. No long-term debt, we throw them out, but there's really few of those. The composition of the sample is described in detail in the appendix to the paper, and very small firms are excluded. And so now here come the results. First result is on the pricing of investment. Okay, now there's the regression specification at the top. It looks a little bit cumbersome, but you'll notice, first of all, in the specification, I've got here the price change for the what I call the net operating assets or the enterprise. This is the return, the enterprise return, okay, which is actually just the effect of debt of leverage stripped out. Just note that this accounting we're talking about doesn't affect the accounting for debt, for financing activities. It's actually in the business activities. So this return on the left-hand side here is actually the return. Actually, it's not the return, it is the price change for the enterprise, where the price change for the enterprise is simply, the price of the enterprise is simply the price for the equity plus the debt, net debt. Then we got the operating income from the enterprise, and we got the free cash flow, which is the dividend from the enterprise, broken up into cash flow from operational cash investment. Then we've got three classes of expense investments. R&D is sitting there, advertising, which we can identify, and which is identified on CompuStat, and then SG&A, which is, I should point out, is SG&A minus advertising, because we've separated that out, okay? So here's the notion that these expense investments are in these three terms, two which can be identified and one which really cannot. We call SG&A here a and advertising too is quasi mismatched because it includes a lot of current expenses also. Indeed, advertising can be to generate current revenues and or to generate future revenues. And so it's quasi mismatch. R&D is pretty explicit that it's actually mismatched because it's incurred to generate future revenues, not to generate current revenues. Special items, taxes, and other things are sorted out in the regression to give us the full specification of the income statement. And then at the end, of course, we have the balance sheet. Okay, you always must have a balance sheet in there, which is the net operating assets, which is simply the enterprise assets or the assets in the business. Okay, so here are the results. The investment book to the balance sheet is priced as an asset. Okay, that's the I here. This is this coefficient here on the investment book to the balance sheet. I should say that this investment here is investment book to the balance sheet, where these three items include the investments expense to the income statement. The coefficient I is 1.22 with a high T statistic. Okay, it's treated as an asset. It's actually treated, priced as a positive NPV asset. When we book investment in the balance sheet, we book it at cost. But the market says, no, that dollar of investment historical cost is worth $1.22. I'm going to add, on average, 22 cents to the market's the accountant's investments to indicate that there's an expectation here of value added. Okay. The t-1 is 2.0. Okay. Now here comes the sort of the critical point. Expense investment is priced an expense R&D is priced an asset, but with a discount relative to the investment priced on the balance sheet. It's a coefficient of 0.65. So the market treats R&D as an asset. That's in previous papers, in 11 Sugiatas and other papers. Hey, the market treats this as an asset, so put it on the balance sheet. But yes, the market does treat it as an asset, not as an expense. But it treats it with a significant discount on average to the pricing of the investment on the income statement. Okay. However, when we come to the quasi-mismatched expenses, it looks like, on average at least, and this is revised somewhere later in the paper when we do some petitioning, that these are treated very much like expenses. The coefficient of about 0.97 on SG&A and on advertising, which say the market actually sees a lot of the advertising as generating current revenues rather than future revenues on average. Now, of course, you can petition on different conditions where that may be different and get different result. But so this is just an on average result. Okay. But the important takeaway here is that R&D is priced as an asset, but with a discount relative to the R&D, the assets booked to the balance sheet. That is, you might say, is a validation of the Penman and Jung JEE paper on the connection to the discount rate. But it also says, look, you accountants, in terms of treating this differently, you are differentiating investment, which is higher risk, and I do have to take a higher discount for. And if you give it to me clearly, which you don't do with SG&A, because you pool it with all these other expenses, then I actually got to assess that this firm, I'm getting some current revenue, but this firm is actually putting some risk on me. I've got to actually change my cost of capital. Okay, there's a hand from Chen. Question, unmute yourself. Unmute. No, unmute yourself.
Okay,
there
so
you
that's
go.
Good. So it's a very good paper. I enjoyed reading it. Why see the results here? I'm wondering, have you considered the implication of survivorship bias? The reason I'm asking is that if you look at the book to balance sheet, that's sort of the coefficient greater than 1, meaning that for those firms who have survived from the past competition, they're more successful in their cumulative performance through their R&D investment. So they gain the value. However, for the company that is investing R&D as of today, their R&D valuation is discounted by the market because as of today, there is chance for success as well as failure. So how do you view the aggregate competition market-wise for the survivors versus non-survivors in terms of their on-balance sheet R&D investment value?
I guess I don't quite understand your question. These are contemporaneous return regressions. The regressions on the left-hand side, the price changes for period T, and the accounting items for those reported for period T. So these are firms that all survived during the period, okay? So I'm just taking the set of financial statements that reported this accounting information, R&D and so on, that are existing at the current time. I've got this set of firms I'm trying to decide which to invest in, okay? Some, of course, will not survive. And if you're saying those from the past where the R&D wasn't successful don't survive and not in the sample, I don't quite see the point, because I'm looking now at those that are reporting R&D and the question whether, in fact, now ex ante to the future, I'm discounting them for the fact that some of them will not survive. Okay, I'm discounting the R&D. Now, if I go into future returns, if I had future returns on the left-hand side, okay, then I'd be more worried about that, okay, because now I have firms that don't survive. Is that clear?
Thank you. Yeah, thank you for the clarification. Another question is about when talking about capitalization of intangible assets, if it is written in accounting rules, say corporations should capitalize, that rule will naturally require the consideration of success risk, a success probability for the R&D investment. Isn't that by itself the consideration of risk if capitalization is applied?
Yes, that's. I think that's the point we're trying to make here, is that that's a consideration of putting it on the balance sheet. That actually a blanket accounting rule that all this investment should go on the balance sheet doesn't deal with this relative uncertainty of certain investments. Okay, this is a consideration of whether you book them to the balance sheet or not. We're just saying the blanket. But the blanket putting every investment on the balance sheet has some implications about risk and the outcomes. Does that answer your question?
Yes and no.
No, I didn't.
I know that you are saying that the blanket capitalization would result in mismatching as well, which I understand. But if we do decide, if a corporation does decide to capitalize the intangibles with the consideration of the potential success and failure probability, if they can do it perfectly, let's say with the crystal ball in their hands, will that be the situation where there isn't mismatching?
Okay, well, thank you. I didn't get onto your question, and you've articulated it very well the second time. Remember, when we referred to that Barker and Penman phase, we actually sort of establish a threshold for doing this, okay? When in fact you can do an appropriate amortization that doesn't create the mismatching, okay? Then you really want to put them on the balance sheet. And that's the threshold. And that actually leads me to my next slide. There's a paper which we just saw recently, which was presented at our accounting design project, which is a worldwide seminar that we're running last fall. It's by Oswald, Simpson, and Irwin. And they find, if giving you IFRS directly to your question, they find that R&D investments deemed successful, that is, they got through phase 3 approvals or whatever, okay, are priced with a 2% premium over R&D investments not yet deemed to be successful, which is very much in answer to your question. Yes, once you get to a certain point where actually the uncertainty has been significantly resolved, okay, then there's an argument for putting on the balance sheet. They're being priced much more like investments booked on the balance sheet, which of course.
Yeah. I thank you for this. I understand. A follow-up comment from my own thinking about the behavioral side of the self-assessment by corporations. So you have two corporations in the same industry. They both invested in some R&D project. By nature of the decision makers, they wouldn't admit ex ante that their R&D investment is more likely to fail than succeed. But if you think they're head-on competitors, so there got to be one winner and one loser by the end. So in the nature of the competition, I think when they decide the capitalization, it's more likely for them taken combined to overestimate the capitalization.
Yeah, well, that's why we have, I guess that's why we have accounting principles that says you can't do that, okay? FASB statement 2 says you can't do it, okay? This is the best way we can handle it. We have sort of maybe very coarse rules that says you can't do that. Now, under IAS 38, where you can actually expense, you can actually capitalize development, there may be issues there. Maybe others in the audience have had experience about the extent to which firms abuse that. As I said, I've been told that most firms actually just go the route of expensing everything still, okay? But yeah, these are issues, but these are the issues of having biting accounting standards which can't be gamed. I mean, that's an eternal issue, right? So, and that gaming can always upset the information that's conveyed. Mm-hmm.
Thank you.
Okay, so now we come into the second thing, the pricing of mismatched expenses. Okay, I'm going to take you through this very quickly now because I want to leave a little time for any further questions. The mean coefficient on matched earnings is 0.94. The coefficient on earnings, it's actually higher than 1 because actually there's growth. You have a multiplier on earnings, okay? You have a multiplier on earnings. That means a coefficient under this methodology, a coefficient with returns as a specification rather than prices. A higher PE means a coefficient's got to be greater than 1. That is, the earnings are worth more than dollar for dollar because you have expected growth. Once you separate these expense investments, however, the coefficient on earnings on matched expenses, or matched earnings, I should say, is on average pretty close to 1. Mm-hmm. And that pertains into the critique of mismatching that says that mismatching affects the inference of the persistence of earnings. Well, actually, once you separate the matched earnings, your matched expenses are actually valued as pretty persistent, 1 for 1. And it's fairly consistent over years, obviously with some variation there. Okay, so we don't have this pertains to the point that mismatching preserves matching. Mm-hmm. Because you don't have those bad amortizations. Once you control for the mismatching, the matched earnings pretty much don't get a multiplier. It's the matched earnings, the mismatched earnings that give you the multiplier. I'm going to skip over just direct you now to the rest of the tables, okay? Because our time is going here. Now we do this on a levered basis because that compares. So we have earnings rather the price change for the equity rather than for the enterprise, and the earnings for the equity rather than the operating income to pair it back to previous work which is done with bottom line earnings rather than operating income. And what we do is now we're going to look over time. We're going to petition on over time, look at coefficients over time, and that's going to be the coefficient on earnings B1, and the coefficients on our match variables over time by subperiods. And of course, we're going to look at the R-squareds. Okay, but we're going to do it by splitting up by the degree of mismatching to see the extent to which it depends upon the amount of mismatching that's going on. And this first, we give some other measures here that the paper will indicate why we have those measures here, but the coefficients here are really the ones to be looking at, along with the R-squareds, which I can't see on my screen because all your beautiful faces on the gallery are covering it up, but I hope you can see it. So here's the case we have. There's no mismatching. There's no mismatched expenses, no R&D, no advertising, no SG&A, and so there's no coefficient values on the mismatched expenses. But you'll notice that in this case here, the average coefficient is 1.22, which indicates a somewhat of a multiplier. Okay. Then we look at cases where there's low mismatching. This is actually the bottom 20% by this matching variable. Here is the matching variable, okay, of all these matches. We break this up into R&D and so on separately, but I'm giving you the composite measure here. Here is the mismatching. You can see that the mismatching actually changes over time, but you'll notice that the coefficients here are fairly consistent over time, and I refer to the R-squareds. There's not much change in the R-squareds over time, okay? The second one here has, in fact, median mismatching. Those are around the median, okay? And that's a similar case. The R-squareds haven't changed over time once we run this specification. And finally, we get those with a very high mismatching. And in this case, this is very high mismatching. And in this case, we do see some lower R-squareds in the last two subperiods relative to the previous years. But we note that these are firms, if you look at the numbers, these are firms which typically have losses in the later years, okay? They're reporting losses. They're reporting actually negative price changes. So they're reporting losses, and the market is writing them down, negative price changes. These are firms with high expense investments. Think, if you will, of a startup biotech with no income as yet, just a lot of R&D. It has negative earnings. The market is writing it down. Says, we don't think this is going anywhere. Okay, we're not going to increase the price because you're making this R&D. We don't think this is going anywhere. It has actually negative returns, and actually has a negative change as a price relative to book value, which is the change in premium variable here. That's the exception. But what we say in the paper is, well, can we expect the accounting to deal with this issue that the R&D is going nowhere? The market is actually pricing it down. Would capitalization versus the expense actually give you the information in this situation? And we actually cannot see it. Okay, that's just asking too much of the accounting. So the bottom line result here is that typically, that once you recognize the property of this mismatching, that it preserves the matching, that it conveys risk about the discount rate, then in fact there's no evidence of decline in the information content of earnings, except in these very special cases where the R&D is going nowhere. The market says the R&D is not going anywhere. It's devaluing these firms in the market. We can't see how accounting can deliver that. If you want to understand these firms, go out and get a Ph.D. in biochemistry. Okay, that'll give you the information. But we can't see how the accounting system can actually give you that information, and particularly how then capitalizing this would actually solve it. In fact, it probably would do damage, putting an asset on there which the market is valuing as very, very doubtful in terms of payoff. The last paper says, okay, now let me look at forward returns, the extent to which these things are correlated with forward returns. If they indicate risk, then in fact, risk should on average, earn you higher future returns, one period ahead, higher return periods. This is return to one period ahead. And you can see that in this case, the correlations are positive for each of these measures here. Okay, when I add operating income, it doesn't affect it. And when I add investment, it doesn't affect it. And this is the case also for the case where there's no mismatching, low mismatching and high. So the market is actually pricing these firms consistent with they're giving these expensive investments a discount, pricing these firms to yield you a higher return for taking on the priced risk from that investment. That ends my presentation. That's the conclusion. which I've mentioned. Oops, the paper is there for you if you want to get hold and read it further. And if you have any further discussion or you'd like a copy of these slides, let me know. I believe Mohammed is going to put this up on video for you to observe later, these slides on video also. Are there any questions? We've sort of run out of time here. Are there any further questions?
Thank you very much, dear Professor Stephen, for your contribution and your effort. It's really excellent presentations. Now, if anyone have any questions, you can open your mic and ask your question. If anyone have any questions, you can open your mic and ask your question. Yes, Professor John, you can open your mic. You have a question?
Yes, I just I was interesting want to get Professor Penman's view about the historically, you mentioned that Brocklev's 1989 piece, and he's argued for capitalized R&D. It made a lot of splash, but it didn't catch up at all. So what's exactly the reason? Is that the reason that you mentioned in this paper about because of practitioners realize if they capitalize R&D, they're going to actually going to mess up the matching, mess up the income statement, or what exactly reason? When I look at it, I'm a little bit younger. When I look at the literature, just okay. Big splash, a lot of the value relevance literature, but there's no, I don't know, the practitioner, never didn't respond. Why is that?
Well, it's not just Bruglev and other academics, and there's been a number of academics who have actually advocated this balance sheet accounting, but it's a huge chorus of practitioners also. I've been involved with an organization in the UK who are pushing very hard to get these assets in this new economy. We need these assets on the balance sheet, okay? And they're pushing very hard. They're pushing politicians. I'm not joining them on that, but I'm sort of advising them and sort of talking to them. And they're actually a very, very thoughtful group. They're all practitioners and consultants, okay? They're pushing at politicians. They're pushing at the ISB and the standard setters in the UK. So there's a huge effort, but it hasn't taken traction. Why hasn't it taken traction? Well, first of all, I'm just speculating, okay, at this point, that actually the standards, the long enduring standards have said no, okay, and it's not just all those accounting standards for R&D, which I've referred to, but it goes back to the 19th century, okay. I want you to be prudent. It's a doctrine of prudence. I want you to be prudent, okay. I think there's a reaction from, when you think it through, hey, you put R&D on the balance sheet, that's going to change my debt equity ratio, make me look less risky. But man, I'm more risky. In fact, so I think there's seeing it as an asset and as collateral. Some people in practice push back about that. But I think probably it's more an ingrown behavioral idea that we want accounting to be prudent. Okay, I'm worried about risk. Okay, but I don't have Professor Jung. I don't have the answer for you. I'm just speculating, but it hasn't taken traction. And although the chorus has been heard by both the FASB and ISB, and they're looking at the accounting for intangible assets now. Okay, I don't think they're going to go anywhere with it, to tell you the truth, because of this long enduring notion of.
So do you think there's also, from the standard setters perspective, there's a kind of a symmetry type of a trade-off? Because when standard setters think about adding liability to the balance sheet, you know, like a pension liability, the lease liability, you know, they hesitated, but still they made it. And but the asset is much much difficult.
Well,
So
but that goes along with the idea of being prudent. You don't want to have a liability, something that's going to come and hit you that's not on the balance sheet. Okay. And the argument would be for the assets. I don't want an asset on the balance sheet that's going to come back and hit me. Water in the balance sheet, which is going to vaporize. I think it's the same sort of mentality, the prudence. Now, I should say the pendulum swings, because you might remember a number of years ago in the ISB particularly and the FASB, when David Tweedy was the chair, Jim Leisinger and Mary Barth were on the board. They wrote the conceptual framework to write out conservatism out of the characteristics, okay? And they replaced it by, what did they replace it by? Representational faithfulness or something or other. And they wrote out, they said, no, conservative accounting is biased, and we can't have bias, okay? Yeah. In the accounting, okay? Yeah. Which went against the previous conceptual documents that said conservative accounting is a matter of prudence, okay? We're dealing with risk here. They wrote that out. Now, from my understanding, and I'm not terribly good, but I do talk to people at the IASB. That's swung back now, okay? Of course, the emphasis back then was on getting more fair value accounting, and the idea that conservative accounting recognized losses but not gains, okay, was seen to be biased accounting, okay? I think it's the pendulum swung back amongst the boards. Or they've taken less interest in it, or we'll see when they deal with their intangible asset project.
So my speculation is that they depend on the economy or the stock market. When you have a long boom period, there's a lot of advocate for, you know, capitalize this R&D. But once you have a decline or a crash of the stock market, remember the fair value sin after 2008, right? And then, you know, everybody pushed back, so they didn't go anywhere. So this is also right now is, yeah.
No, you're right. You remember the 1990s. A number of the audience were too young to remember the 1990s, I guess. But the cries for actually booking these intangible assets on the balance sheet, as all these firms, these internet startups, went to huge valuations. What are you accountants doing? Look at the prices, and you haven't got the assets on the balance sheet, okay? And you're reporting losses. Well, sure enough, after reporting losses for 3 years, these firms crashed, okay, in 2000. But you're right, that went along with a boom in the stock market, like the 1920s. Maybe this year we're going to get more, as we get boom times, maybe we get more. Well, you accountants get the assets in the balance sheet. You're missing out on something.
Thank you.
Are there other questions? If anyone have any questions, you can open your mic and ask your question.
Stephen, thank you very much for your presentation.
Is that Penguo, is it?
Yes.
Okay, how are you doing?
Very nice to see you. We'll talk about this value relevance. Basically, we have this two levels. One is just the level value, and the other one is the change in value. But in your paper, you talk about a change in value. But it is the case, if we talk about level value, then stock variable is more relevant. When we talk about a change in value, then flow variable, earnings, may be more relevant. Is that the case? Because I'm not sure. If
I'm not sure about that. See, and
if you change all your regression from this change in value to stock value, to just a value, just a level value, will the result change?
Well, I'm not sure about that. The change variable, of course, is the change in the price. Okay, so it includes the price at the beginning. It's the value. It's the pricing at the end of the period relative pricing at the beginning. The pricing beginning is known, of course, so it's actually the pricing of the at the end. The right-hand variable, accounting variables, are change variables. The income under accounting principles, earnings is a change. Earnings is a update of the equity, okay?
Sure.
It's how you update the equity during this period. So if you've got a change variable on the left-hand side, on the right-hand side variable, you need a change variable on the left-hand side, okay? You need to initialize by the beginning, you need book value and the initialization of the beginning book value. So what you're thinking about perhaps is, I want the price. What explains the price? Well, the price should be explained by a levels variable, in addition perhaps to a change variable, okay? But changes on the left-hand side mean changes on the right-hand side. Now you can run a regression on price, on earnings and book value, and that's quite legitimate, okay? In fact, we know from the theory that you well know that you can characterize price as being a weighted average of earnings and book value under an Olsen type model, for example. So that's quite legitimate. And we know those coefficients are going to be based upon the evolution of those numbers, particularly the persistence of the earnings. So you can do it that way. Yes, indeed.
Yes,
There are econometric issues, okay?
right.
OLS doesn't work quite well because of heteroscedasticity and a number of other issues, okay? The notion of a price per share and earnings per share is an arbitrary number because it just depends on shares outstanding. So there is just a bit, but you can do it both ways, yes.
That's right, okay.
But you can actually convert a change regression, given that everything's initialized in those regressions on PT at the beginning of the period. Of course, you can convert these into a levels regression. Right. And the multiplier on earnings in these regressions is just a P in earnings, and you can go in earnings in returns, okay, which you can just readily convert to a PV in levels, okay, right, yeah, because everything's denominated through by the beginning period price.
Yeah. The other thing related to one of your regression, in the equity level regression, for what reason why your right-hand side control free cash flow this ratio?
In the levered regression, because I want to, actually, if you go through the specification says that free cash flow should have no relevance for the pricing, okay? And it's in the paper, not reported here, that actually the coefficient on free cash flow is actually 0. Oh, right. It has no effect on earnings. That's a basic notion of accrual accounting. It's accruals that convey value, and free cash flow is irrelevant. It's sort of M&M. The cash flow doesn't matter. Okay.
Right.
So that's there because I just said but actually that's under M&M assumptions. Okay. But it could be also, however, that given relaxation of M&M assumptions, frictions in the market, asymmetric information, that free cash flow could apply additional information. So I'd want to control for that. Okay. Right. I want to control for that. Just as dividends could be a signal, so free cash flow could be a signal, even though in the accounting it doesn't affect earnings or the book value of equity. Right. So it's there to complete the accounting system. I want the cash flow statement there and control for information, the cash flow statement, if any. It turns out on average is none.
Right. So I expect there financial leverage in that regression.
I should have financial leverage in the regression.
Just replace this. It's a cash flow, free cash flow term.
No, it's in the regression because given book to equity is there, and that includes the debt. Okay, so I think beginning leverage is in there. Okay, and as we know, leverage affects the book to price to book ratio. So it's implicitly in there, the leverage.
Right. Okay. Thank you.
Is there another question? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Stephen Penman, for your contribution and your effort. Thank you very much. And it's all that remains for me to say is thank you everyone that joined us. And I thank you very much for taking the time out to present to us today, dear Professor Stephen Penman. It's been really appreciated. Thank you very much.
And I thank everyone for your for your listening abilities and for your questions. Thank you very much for this opportunity.
Thank you.
Bye-bye.